respect everybody's time, so we'll go ahead and begin. So officially, good afternoon, everybody, and thank you for joining us today. Part of Richmond Jewish Foundation's mission is to engage, educate, and inspire generations of donors to create ongoing resources for charitable, religious, and educational needs. To fulfill this part of our mission, we periodically provide seminars related to plan giving and philanthropy. Today, we'll explore the impact of COVID and the election on estate planning, tax planning, and philanthropy, basically what to do before the end of the year. So as I mentioned, the Q&A feature is open. Please feel free to ask any questions, and we'll try to get to them during the webinar. If not, we'll try to answer them afterwards. Joining us, as you can see, from Glenmead, RJF's investment manager are Nina Cohen, Adam Konish, and Lisa Whitcomb. Nina is the Director of Endowment and Foundation Advisory. Nina and her team provide advisory administrative services for foundations, endowments, and other nonprofits. Adam Konish, Director of Endowment and Foundation Investments, is here. Adam provides investment advice and portfolio management for foundations, endowments, and other not-for-profit organizations. And joining us is Lisa Whitcomb, who is the Director of Wealth Strategy for Glenmead. Wealth Strategy for Glenmead Private Wealth. In this role, Lisa oversees tax, estate, and financial planning, and is a senior advisor for fiduciary and estate matters across all of Glenmead's offices. Thank you, Nina, Adam, and Lisa for joining us. And now I will turn it over to you.
Great. Thanks a lot, Robert. And so I'll share the screen right now. And as Robert mentioned, we're going to go through basically a quick overview of where we stand from an economic and market standpoint. Then, as he mentioned, Lisa and Nina will talk about the tax landscape as well as planning for charitable giving. With that being said, as Robert mentioned, please feel free to use the Q&A function. We will be monitoring that. So if you have questions, please type them in, and we'll do our best to answer them either real time or as we move through the presentation. So with that, I'll begin with a very brief economic and market overview. So we're going to start with a picture of the S&P 500, where we currently are today from the beginning of the year. And what you'll see as you look at this graphic, it was a very sharp down move, as we all know, in the month of March. And just as fast as it was down, we actually saw a pretty sharp recovery. So we're calling this a V-shaped recovery in the market, just since we basically went into lockdown in March. And you can see that not only have we recovered to where we were back in January and February, but the market's actually made a new high in this time period. And when we step back and we ask ourselves, why has the market made a new high in a very, very strange and unique environment? It's actually not because we've seen a cure or a vaccine for COVID come along. It's not because corporate earnings are robust. It's really because of all the fiscal and monetary stimulus that we've seen be put into the economy back in March through the summer and into fall. Really, the market has been trading off of what has occurred from the government's standpoint. And when we take a look at that, it's like nothing we've ever seen before. And what we're highlighting here is the actions that the Federal Reserve took back in March, and as I mentioned, throughout the summer and where we are now. And really the whole takeaway here is that the actions of the Federal Reserve are actually bigger than what occurred back in 2008 into 2009, the global financial crisis. So the Federal Reserve was extremely aggressive in trying to stabilize the markets, try to put liquidity into the markets so they would function properly for trading, for example. And really what they did was not only did they bring that stability, but they also brought the recovery to the markets as well. We saw very similar actions at the same time with what Congress did. And what we're showing here is the fiscal stimulus plans that have been enacted as a percent of GDP. And you can see here, once again, the actions that the government took as we went from March to present day have been unprecedented. They're larger than what we saw back in the global financial crisis. When we take a look at the stimulus from a global perspective, it's 30% of world GDP. That's a very large number. These are the two underpinnings that are really giving stability to the markets, as well as, moving it to new highs. I would also say that we've had some positive headlines. I wouldn't say news, but we've had some positive headlines with encouraging information on a vaccine. Typically speaking, the market tends to look 6 to maybe 9 months down the road. And that's actually why we're continuing to see the market move in the right direction, meaning up, with regard to news that we received last week from Pfizer's potential vaccine, and even this week on a vaccine for COVID-19. The market looks at that and looks at it as a positive sign, which is why we still continue to see the market moving slowly but surely up and the economy recovering at the same time with talk of another perceived slowdown. So really the market's digesting both of those aspects, but continuing to really examine the monetary and fiscal stimulus that has been put forward, as well as the potential for a vaccine. So how do we measure the health of the economy at this point in time? Well, a lot of the economic data that we saw come out in the beginning of the end of the first quarter and the beginning of the second quarter, you had to take with a grain of salt because it was just such a unique environment with the economy being shut down. But as the economy has slowly but surely began to open, we can actually look at more reliable data. And what we're showing here is consumer spending. When we take a step back and measure the health of the economy, we're going to always look at GDP, gross domestic product. And then when we look under the hood and say what drives GDP, it's actually consumer spending. All of us on this call spending in the economy. We account, the consumer, for over 70% of economic growth here in the United States. And you can basically make the same assumption for developed countries around the world. What we're highlighting here are the various metrics of consumer spending. The dark blue line is all the light gray lines in aggregate. So when you talk in terms of overall consumer spending, that is the dark blue line. When you look at the various components, it's not hard to ascertain which ones have done well in this environment and which ones have actually had a big headwind. The first one that jumps out at you is grocery. The ones that actually have not done well are the ones that you would imagine: leisure, entertainment, recreation. But the takeaway here is that we have seen a stabilization in consumer spending as we went through March and into April and into May. And we've started to see that continued recovery in spending. This is indicative of the economy starting to come back online. If we look at the economy in a different lens and say, making the assumption, knowing that the economy back in January and February was at full potential, and then using that as a frame of reference, at this point in time, the economy is right around 80% back online to its potential. It may not feel that way in certain areas, but when we look at the economy in aggregate, we have made up a lot of ground that was lost back in March, April, and May. So once again, the economy moving slowly but surely in the right direction, as evidenced by spending and other items that we look at. So COVID, this is something that we were talking about at the very beginning of the presentation, talking about where we currently are in the economy. There will be pockets of the economy that will have restrictions put back in place. At this point in time, our base case is not to have another shutdown, meaning countrywide shutdown. We do believe that local municipalities, cities, even state governments may impose different types of restrictions, but at the same time, we're not looking for a full US shutdown of the economy. We have seen a spike in cases. You can see here that we're showing not only domestic, but global upticks in cases. And you can see that we have basically moved into an area that we were back into the late first quarter as well as midsummer. There's a couple of takeaways from this chart that really we've been focusing in on. Even though there is an uptick in reported cases, we haven't seen an uptick in reported deaths and even hospitalizations. Just through the channels that we typically look into, we believe that the technology and the healthcare aspects of being able to treat COVID-19 have vastly improved. And that's why we're not seeing a lot of the deaths that we saw back in the very beginning of March and into April, which is a positive sign. So an uptick in cases, but at the same time, it looks like we are doing a better job of not only treating those with infections, but also preventing them from passing. When we look at terms of what's the market looking at, I mentioned earlier that there were some positive developments on the vaccine front. Now, what we're highlighting here are the various companies and their demographics and geographies that are working on a cure or a vaccine for COVID-19. And as I mentioned, in the past 2 weeks, we've received some positive developments, which the market has definitely latched onto in a very, very positive way. We do believe that we should have some more positive news as we move through the beginning of the first quarter and even into the second quarter of the upcoming year, and really look for continued progress on that front. The market is expecting that. And what I would say is that everything that we're looking at this point in time does indicate that we should have some positive news as we move through the first part of 2021. But at the same time, because the market's expectations are lofty, any type of news that maybe signals that we're not on path to get a vaccine one way or the other could create volatility. But when we talk in terms of market volatility, we do believe that as we have fiscal and monetary stimulus packages in place, as well as the economy continuing to move in the right direction slowly, that should help mitigate any type of significant volatility that we experience in the marketplace. And that really leads into the next slide that we have in talking about what are those scenarios. When we look at where we currently are in this environment in November, we've really adjusted our investment strategy and our investment thesis down to two, what I would call cases. Back in March, you can see that we actually had four different types of scenarios that we were looking at when really the unknown was occurring with the first appearance of COVID-19. What we have here now is the base case, which I've been speaking about on this call, in saying that we do believe that the market and the economy will continue to move in the right direction slowly. We do expect that there will be monetary and fiscal stimulus in place as we move into the new year. It remains to be seen if we're actually going to get another fiscal stimulus package, but at the same time, that's something that should appear as we move into 2021, which will support the market. At the same time, we are not married to this thesis. We do scenario analysis. We look at the upside as well as the downside. If in fact we do get negative news on a vaccine that I was talking about earlier, or at the same time we start to see softening of economic data, that would cause us to rethink our strategy, rethink our positioning in the marketplace. But that is not our base case at this point in time. We continue to do scenario analysis internally and really formulate how we want to be invested given this environment. Based upon the current environment, we've seen pockets of opportunity as well as pockets of where we would be a little bit more cautious. And from the standpoint of looking at the equity markets, what we're highlighting on this page is that there are some very big discrepancies within the marketplace, especially US large cap equities. You may have heard about growth stocks, value stocks, large cap stocks, and small cap stocks, and their international counterparts. Well, what we're seeing at this point in time, as you might imagine, the best performing stocks in this environment have been large cap growth stocks. And I'm sure we all know them because probably use a version of these companies every day, whether it's Facebook, Apple, Amazon, Google, Netflix. I think I get an Amazon package every single day, so I should actually buy stock in that company. But what I would say is that you have these companies that have done very, very well in this environment, but you've also had some companies that have not really participated in the market rally that we've seen. And you can really classify those more along the lines of value stocks. Value stocks at this point in time appear extremely attractive on a relative valuation basis, meaning looking at their value versus how a growth stock is valued. But at the same time, there is a gap between the two. And so when we talk in terms of looking for opportunities in the marketplace, we do believe growth stocks will continue to do well in this environment, but also believe that value stocks, as the economy opens up, as it moves in the right direction from an expansion standpoint, value stocks should catch up and should actually benefit from an opening economy. In many instances, value stocks are a little bit more economically sensitive. They're more cyclical to the health of the economy. So as you get an economy that slowly but surely opens, that should benefit and close the big gap that we're seeing between growth and value stocks. At the same time, we have an election or post-election, excuse me. And what I wanted to end with on this part of the presentation was the market, over the longer term, tends to actually not favor one scenario over another, meaning one party over another, or who controls the House of Representatives, or who controls the Senate versus who's in the Oval Office. And what we're highlighting here on this page is that you can really see very similar market experiences as you look at the different types of scenarios. So really the takeaway here is when you have a Republican president in office, the post 4 years of that presidency, when that person is in office, the Republican's in office, the market's returned about 8.3%. When you look at the same exact scenario for Democratic presidents, which is the very bottom bar graph, you can see that the return on average over that 4-year time period is 8.9%. And then when you start to match up the different segments, what you'll find here is that very similar market returns. At the same time, when you have divided Congress or someone in the office that is not a member of the controlling party, we call that gridlock. And gridlock is actually a good thing in DC, because what that means is that the market has visibility. Gridlock typically means that there's not going to be any sweeping changes or reform. And the market likes that because the market can have that visibility down the next 2 or 3 years of knowing that there won't be any changes. So with that being said, we currently believe that we're slowly but surely opening up as an economy. There will be road bumps in the road ahead, just given where we currently are moving into the end of the fourth quarter, the winter months. But at the same time, the expectation is to weather that volatility and actually continue to move along the path of recovery, move along the path towards a vaccine as we go through the first quarter and into the second quarter of next year. And that's exactly how we've currently positioned our portfolios. So I'm going to stop there, and please ask questions through the Q&A. And I'm going to now turn it over to Lisa.
Well, thanks, Adam. I thought that was all actually really helpful. Hopeful, not helpful. Helpful too, but hopeful. I'm going to talk for a little bit about how we want to finish up the year. The 2020 legislation, what we need to look forward to on the taxes with the Biden presidency, the year-end planning, and then sort of a pull back, bigger picture. Adam didn't talk about interest rates, but interest rates have stayed low, and that does give us a number of opportunities. So legislation first. Adam, you're driving, right? Okay, thanks. The Secure Act. The Secure Act came at the beginning of the year, and then we all promptly forgot about it, or at least couldn't deal with it because we were dealing with the pandemic. So I want to bring your attention back to this. The 2020 Secure Act has made major changes to retirement planning. The things you need to know are, well, you know, the required minimum distribution from your IRA, your 401k, that's now age 72. No one had a required minimum distribution in 2020, although you could still take a distribution if you wanted to, and perhaps Nina will talk about that just in the context of charitable gifts. The 2021 RMDs are going to be smaller. And that's because the IRS now thinks you're going to live longer. They think you're going to live 2 years longer than they thought 10 years ago. So maybe at age 72, now they thought you were going to live 24 years. Now they think you're going to live 26. But most importantly is with the Secure Act, they changed a number of provisions with respect to your beneficiaries. So if I die and leave my IRA to my daughter, until this year, I could then let my daughter take that IRA out over the rest of her lifetime. That's what's called a stretch IRA. You could stretch it out over your beneficiary's lifetime. That has gone away except for your spouse. So no longer can I take this asset and expect that it can grow tax-free for another whole lifetime. It must be paid to your beneficiary within the next 10 years, 10 years after your death. Now, what does that mean for you? Everybody needs to be looking at their beneficiaries for their IRAs. Many of us might have used trusts. I might have used a trust for my daughter because I didn't really want the spouse to get to those IRA funds. And I want to be very sure they're locked up as tightly as they can be. Well, it doesn't work so well anymore if the entire IRA has to be paid out over 10 years. So I need to be changing my IRA beneficiary designations and looking at that carefully in the context of my entire estate planning. But now we'll just turn right to the election, because the election has left us for tax and estate planning purposes between a rock and a hard place. We are there because we don't know what the Senate is going to do. And because we don't know what the Senate composition is going to be, we don't know if we need to make what kind of planning we need to do for the end of the year for sure. How did we get there? We know, and we'll review in a second, what some of the big proposals were for Biden tax increases. But those big tax increases were only going to happen if there was a blue sweep, and that's gone, right? So now we've got two choices. We've got a 50-50 Senate, or we've got a GOP Senate. Now, if we have a Republican Senate, it's unlikely that any of the tax increases are going to occur, probably at least within the next 2 years, because of course there's another senatorial election in 2 years and all bets are off for that. But now we're here in November, knowing we have a December 31 year end and trying to make decisions about how to plan for something that we don't know, we just don't know the outcome. We've got the Georgia Senate races, which don't occur until January 5th. We have one of those races where the Republican clearly won, but he didn't win with a margin that was over 50%. There's a Libertarian candidate that drops out of the January race that had a 2.3%, and the Libertarians will almost certainly vote all with the Republicans. So we're pretty sure that we're going to have a Republican Senate, but we're not certain, and it's, who knows? I mean, it could be the most expensive Senate races we've ever seen. And because of that, we have to think that we could have a 50-50 Senate with Harris as the tiebreaker. And if we do, we may have some limited tax increase. It's very, very unlikely that we would have see big corporate tax increases or the payroll tax increase, which was Social Security that they talked about. But there is potential for some moderate individual tax increases, and we don't know when those are going to occur. With tax legislation, you can go to the next slide, Adam, thanks. With tax legislation, you can enact a tax in July as part of the budget process and make that tax retroactive to January 1st. In fact, the last 2 tax changes, that's what's happened. So what tax changes are we possibly talking about? We're talking about a small change to the top marginal tax bracket if you have income over $500,000 or $600,000. We're talking about a possible long-term capital gains and dividend rate, an increase from 20% to 40%, but only if your income's only over $1 million. We probably would, many of us would welcome a return to the itemized deduction regime that we had before. Estate and gift tax. If we were to see some of Biden's tax proposals go forward, he has proposed that we drop the exemption, the estate tax exemption, from an $11.5 to $3.5 million and increase the estate tax rate from 40 to 45%. And lastly, one of the things we all have been worried about is a cost basis step up, removal of the cost basis step up. You know, today at death, if I have some assets that if I've owned Amazon since it was $5 a share and it's now, I don't know, $300 a share, that gain is not taxed at my death, and I get a new cost basis when I die for my heirs. The proposal is to take that away. Now, one of the things we have to bear in mind is that all of the Trump tax cuts go away on December 31st, 2025, most of them, because that's as long a period as they could have within the budget constraints to enact those tax cuts. So even though we may not see the tax increases that Biden proposed, or we may see something very much moderated, we do still have to plan in the back of our minds for December 31st of 2025. All right, all that being said, what does that mean? Well, if we think there's a realistic possibility, I don't think there's a realistic possibility, but some may, and I don't want to discount it. If you think there's a realistic possibility that the Democrats could take the Senate come January, then we're looking at planning for some rising tax rates. And we are thinking about things like taking capital gains today that I might not otherwise have taken before. If I have $1 million portfolio and that's getting constantly turned over, there may be assets in that portfolio that I want to sell now this year and pay what I know to be the capital gains rate of 20% or 23.8 if you're paying the Medicare tax. I might want the certainty of knowing that I have that capital gain rate today. I don't have a surprise later in 2021 or a surprise in 2022. I think that where this is playing out for most people is that their entrepreneurs are trying to get their companies sold before the end of the year to get that certainty around capital gains. And people who have very, very large capital gains and are budget those out over a period of years are trying to accelerate those into 2020. Similarly, there's income that you might want to accelerate. If you have stock options or you have some deferred employment income that you can accelerate, you might want to accelerate it into 2020, but really only if you think the tax rates are really going to go up next year. Because remember, by accelerating any kind of income, whether it's capital gains or ordinary income, by accelerating it into 2020, taking it now, we are losing the benefit of the deferral of the tax and a greater chance at greater growth and wealth down the line by deferring paying tax now. Okay. The other way you could accelerate income is a Roth IRA conversion, and these come into play really in a couple of ways. It's not necessarily all about wanting to accelerate income into this year. I would be talking about Roth IRA conversions with you for end of year-end planning in any case, because it's about the play in the brackets. There are different breakpoints in the brackets for income tax, and there can be an opportunity to convert a Roth IRA into a traditional IRA, meaning you pay tax on the Roth IRA now, but on the traditional IRA, you pay tax on the withdrawal from the traditional IRA now, put it into a Roth and never pay tax again. By using your income tax brackets, you can plan for that to pay at lower rates over time if you have a good sense of what your future income tax picture is going to be. And last but not least, what we always talk about at year end is charitable gift planning. And I'm going to leave that totally alone and leave that to Nina later. So action items here. So you review your income tax strategies with your accountant now, don't wait. If you are a lover of politics and you are watching these Senate races with an eagle eye and you really think there's a chance that the Democrats could win both seats, they need both, not one, to have 50 members in the Senate, then accelerate your income. Okay, what are the other housekeeping items of things that you would be doing anyway if you were doing year-end tax planning? Well, taking advantage of breakpoints in the long-term capital gains rates. Remember, I said there's breakpoints at different income levels for your tax rate, for your overall income tax. But there's also breakpoints in capital gains rate. And so if you have income of less than $40,000, I don't know, it's the year you retire, and for whatever reason you have almost no income this year, you get a 0% tax rate on your capital gains up to with income up to $40,000. Similarly, you've got the whole window from 40 to 440 for a 15% rate. When we think about capital gains, I almost always talk about it in terms of, oh yeah, you're going to pay 20% on your capital gains, but not always. Really, there's a large chunk on which you can be paying 15%. So use up that bucket if you can. If you think you're going to have higher income in future years, use up that bucket to pay a lower rate on your capital gains. End of year, make sure you fully fund your IRA or your 401k so you take that out of your taxable income. If you have family trusts, there could be an opportunity. Now, trusts pay income tax at the very highest rate for every dollar of income over $12,000. Well, goodness gracious, if there's a more tax efficient way to look at your family structure and distributions from trusts, do it. If I can take $10,000 from the family trust and pay it out to my daughter, who doesn't make very much, and she's paying at the lowest income tax rates, if I can take that $10,000 and tax it out to her from the trust, instead of having the trust pay 40% on it, well, I'm going to do that. if it makes sense in the big picture for her to have $10,000. We're going to, how about funding 529 plans? Still a great thing to do. And even some states allow you a deduction for that. Make your annual gift tax exclusion gifts to your heirs, $15,000 per year can go to every person you know, every person you want to benefit, without having to report it on a gift tax return or having it use up your exclusion amount. And then lastly, but just as importantly, if you have family members that you're trying to benefit, and one way you could or want to benefit them is to pay their tuition or medical expenses, do that. It's not a gift to them. It's not taxable income to them. And it's a great way to help out without, again, using up any of your state tax exclusion. Okay, so that was the income tax side. Let's talk for just a couple more minutes about estate and gift tax. This chart, if you can see at the bottom line, is the rate at which over time since 1917 when the estate tax started. That bottom line is the line which shows us what the estate tax rate has been. Okay, and the bottom line, the top line is what the estate tax rate has been, the lighter blue line. And over time, it has been as high as 70%. Right now it's at 40%, and it has sort of settled in around that level for now. We'll see. But it has been a very high number, and there were a lot of years where estate tax was very, very significant part of how we redistributed wealth in this country. The estate tax, the exemption rate, that is the value of dollars that you could retain in your family without paying estate tax, was for a very long time around $1 million. And now, of course, we're at 11.5 million. When you think about this, again, what's in the back of our minds is, when is that estate tax exemption going to fall again? Because now it's at 11.5 million. You can see that dark blue line along the bottom has had us at $1 million, certainly not much more than $3 million for a very long time. If it goes back to the norms, what do we need to be thinking about with respect to saving estate tax? All right, let's take a family with $15 million. That's the next slide, Adam. And what is this? What am I really talking about? Today, if my family had $15 million, oh, I wish we did. If we had $15 million, the exemption amount would cover everything, and I would pay no estate tax when I died. In the Biden proposal, well, that should be 3.5 million. There's a $3.5 million exemption, and I would pay, I'm sorry, in the Biden proposal, where the exemption amount was 3.5 million a person, which is 7 million for me and my spouse, I would pay $3.6 million of tax. That's a pretty substantial difference, right? That's what we're worried about. In 2026, when the Trump tax cuts end, in all cases, then the tax would be $1.2 million, because we'd each have about a $6 million exemption. It's going to float, but it's about $6 million. This is the future I'm looking at. This is the uncertainty I'm looking at. This is why I'm between a rock and a hard place today, because I don't know if I should be trying to give away money to my heirs today. All right. Well, how could I give money away how can I use up my exemption amount? I can, from low complexity to high complexity, I can make an outright gift to the heirs. So but guess what? I'm not giving any of my kids $1 million. Not to say 10 million. I could make a gift to an irrevocable trust for my heirs. That's a great way to use up my $11.5 million exemption. Does it make sense for me to do this kind of gift if I'm only going to give away $3.5 million? Probably not, because we don't think the exemption in all cases that we know of now, we don't think the exemption is going to go below $3.5 million a person. So if all I have is $7 million, oh golly, if I have $7 million, I'm not going to be making any of these irrevocable gifts today. But if I have between $7 million and $23 million, I'm thinking about making gifts. There's all kinds of trusts that they could go to. Last but not least, there's something that people have been talking about a lot, which is a gift to a spousal lifetime access trust, which is called a SLAT. I'm not going to go into the details, but this is really for families who want to try to give away as much as possible, but they want the just in case. I'm ready, willing, and able to put $10 million in a trust for my kids, but what if the heavens fall? What if my husband really needed that money at some point? What could I do? I'd create a spousal lifetime access trust. I could never get back to those funds, but he could. So that's what people are doing today to try to use their gift and estate tax exemption. Now, last but not least here, we want to talk about the rest of us who don't have $11 million to give away. What are we doing? We're trying to understand first, and most importantly, what we need personally in our family to retain, to keep our lifestyle in the way that we want it. So I may find I need $5 million, no matter what, to maintain my lifestyle. Great. But anything over that, I'm willing to think about ways to benefit my children. Well, how could we do that? Way we're thinking about that now, and again, this is end of year planning, this is next year planning, this is the big picture of trying to freeze the taxable estate. So it comes back to, all right, what if we think it's going to go to 3.5 million? Maybe it'll go to 12 million. Today we're at, maybe it'll go to 6 million. Today we're at 11.5 million. What if I want to hedge my bets, but I don't have a huge pot of assets? Let's see how we can get some of the growth of our portfolio out to our children. How could we do that? One way is a family mortgage. The three things I'm going to talk about now are 3 ways to use the low interest rates and the volatility in the market to benefit our children when we think we're ready, willing, and able to share the growth of what we have with our children now. Here's the easiest one. My 30-year-old wants to buy a house. She can go to the bank and she can get a commercial mortgage at, I think I based this one on I think it's down here, a 3% commercial rate, right? That's the that's the line, the top line there. But I'm willing and able to lend those same dollars to her from my pocket at 1.04%, which is what or 1.6%, which is what the IRS tells me is the minimum rate that I can lend funds to my child without it being a gift. So I'm willing to lend it to her for 1.6 and take a mortgage, but the bank's willing to lend it to her for 3%. If I make that loan to her and I can afford to do that, I am essentially giving her over the next 15 years for a 15-year mortgage, I'm giving her over $100,000 of savings, and it's not a gift. That's a terrific way to share the growth in your portfolio without creating other bad financial consequences or tax consequences to the family. The next example goes a little bit farther. The next example says, well, you know what? I have $1 million. I'm ready to loan, not to my 30-year-old because she's not quite ready. I'm ready to loan it to my 40-year-old. And he's going to take that $1 million and he's going to invest it. He's going to promise me, and I trust him, he's going to promise me he's going to invest that. And he has to pay me back the $1 million in 3 years. But he's going to have, look at this, at a 7% growth rate. If I only have to charge him 1.22% on that loan, and he can make 7% by investing it with Adam, well, golly gee, what does he get? He gets $250,000 of untaxed he gets $250,000 of growth that the gift and estate tax people are never going to see. Remember, if I keep that in my pocket, it's going to be subject to estate tax at my death. So I get to pass that $250,000 to my child, essentially gift and estate tax free. Great. Well, I don't really trust him that much, so I can get more complicated with that. With this, I can go ahead and do a GRAT. You've heard of a GRAT, a grantor retained annuity trust. It works exactly the same way. You're loaning money or you're paying money into a trust. You're getting the money back eventually. I'm getting that $1 million loan back. I'm getting it back because I need it, but all the growth on the portfolio goes out to my children, estate and gift tax free. So that's what we're thinking these days. We're thinking, all right, if we have a Republican Congress, we don't think there's going to be any real tax increases that we need to be worried about. And if that's so, then it's business as usual. It's the blocking and tackling. It's the doing my regular year-end tax planning and thinking about things like getting the growth out of my estate. That's what we're worried about. If you think there is a non-minimal chance, or even a minimal chance, if you think there's any chance, I'll amend that. If you think there's any chance the Republicans can take both seats in Georgia, we come right back to politics and the place where we are between the rock and the hard place with respect to what you need to do by the end of the year. And with that, I'm going to pass that to Nina to talk about charitable giving, because I left that whole part out of the income tax planning.
One quick question, Lisa. Do these family mortgages have collateral? If the child doesn't repay, is that a taxable loss on your taxes?
When I do them, I treat them like real mortgage loans. So if they don't pay and I have to forgive it because I don't want them to lose their house, if I forgive a loan to my child, that is income. When anybody forgives a loan, that's always income to the person who was the debtor. And the only time there's been a deviation from that has been recently with some of the commercial loans and some rules around those from when we had the real estate, the 2008, 2009 crashes.
Great, thank you. Go ahead, Nina.
Great, well, thank you. Lisa spent some time talking about year-end planning for a family, and I'm going to spend the next few minutes talking about year-end planning for a community, for charity. And this has been a very challenging year for all of us, but in particularly for the nonprofit organizations and the people that they serve. In the first half of the year, we saw a decrease in charitable giving compared to last year. But then the CARES Act gave us some tax incentives that I'm going to highlight in a minute in an attempt to increase charitable giving. But that being said, most nonprofits still have seen a decrease in revenues while the demand for services has increased for those most vulnerable. So now's the time we're going to focus on charitable giving through the end of the year. Next. So as Lisa mentioned, there were sweeping tax law changes in 2017 in the Tax Cuts and Jobs Act. And some of the key provisions that affected charitable giving were the higher standard deduction. And that was a negative because fewer itemizers, so less people are benefiting from the charitable deduction. Then on the plus side, there were some increases in the deduction for cash contributions to public charities. That includes staffs to 60%. And the IRA charitable rollover that I'll talk about in a minute was also extended. Now, the CARES Act that I mentioned earlier had certain provisions, to help increase charitable giving in 2020. And two of these special provisions were as follows. One for itemizers, able to deduct 100% adjusted gross income for cash gifts to charity, with certain exceptions. And that really helps for large gifts of cash to offset income I don't think we're going to see many taxpayers taking advantage of that provision. But for non-itemizers, there's a $300 above the line deduction for cash gifts to public charities, again, with some exceptions. And I think this is going to be beneficial, particularly for seniors, for example, who may not itemize, and for others who are not taking advantage of itemizing their deductions. So let's turn for a minute to just an overview of the types of property that you can consider giving here at year end. So certainly giving cash, through checks, electronic transfers, even credit card payments up to the very last minute on December 31st are simple ways to give charitable gifts and really allow you to take advantage of the increased deduction limits if you itemize, or that $300 above the line deduction if you don't itemize. Of course, long-term appreciated assets have a much greater tax benefit for most people than giving cash to charity. So for example, that Amazon stock we've been talking about that you've been holding for the past few years, that's increased significantly in value. A donation of this stock will qualify for an income tax deduction based on the current value of that Amazon stock, that high value. And both the donor, you, and the charity will avoid capital gains when the charity eventually sells the appreciated asset. And just so you know, RJF and Glenmead make it very easy for donors to make stock gifts. And Robert can certainly walk you through that process. And the other asset that I want to mention, Lisa had as well, are IRA assets. And although, as Lisa said, there's no required minimum distribution for IRAs this year, donors over 70 and a half can still consider using a traditional IRA to make a qualified distribution directly to charity. And the benefit of that is that you never recognize the income, so it doesn't show up on your tax return. And RJF has funds that are qualified recipients for IRA qualified distributions. So the next technique that I want to talk about is bunching, and it's something you've probably heard a lot about in recent years. And bunching is a technique that donors use to take advantage of the income tax charitable deduction. And what it means is that what you would normally give in multiple years, you are giving in a single year. You're bunching your donation together in 1 year. So let's give an example of what bunching might look like. So in this example, we're showing the benefits of doubling up in giving in 1 year versus spreading out the gift of $25,000 over 2 years. So you'll see without bunching, each year the donor loses the benefit of that $25,000 charitable gift because it's not worth it to itemize deductions, just takes the standard deduction. With bunching, on the other hand, in that middle example, in the first year, you'll see that the donor gives $50,000 in that 1 year. And now the donor is able to itemize in that year. The following year doesn't make that, take the deduction. It doesn't itemize deductions. However, over the course of those 2 years, you'll see that for a typical taxpayer, there could be a tax savings of $3,500. So when we talk about the bunching technique, certainly an option is to give cash or other assets in a bunching fashion outright to a charitable organization like RJF. But for some donors, they'll take advantage of the donor advised fund, and that's really an excellent recipient of bunching. And for those of you who are familiar with the DAF, it's a giving vehicle that donors might think about, kind of like a charitable savings account, from which the donor advisor can recommend grants over time. The benefit is you make the gift today, it's an irrevocable gift, take advantage of the tax deduction in 1 year through that bunching, and then assets grow tax-free. And you have the ability to distribute those out, recommend grants over time with the assets that are inside the DAF. And DAFs are extremely flexible. They can really be established in a matter of days at no cost. And many families now, are using DAFs to organize their charitable giving. It simplifies giving, one receipt. and engage the next generation, because DAFs can last for multiple generations with successor advisors. So just to wrap it up before we move into some questions that you may have, I just wanted to talk about legacy planning. And Lisa talked about estate planning for family, but it's also a good time to be thinking about legacy planning for the community. So there are a couple of things you might want to consider. There's certainly a bequest. It's a good time to be looking at your estate plan, your wills, your trust, making a bequest to charity. Also thinking about your beneficiary designations, life insurance, retirement benefits, or even creating an endowment fund in perpetuity. So let's talk about how to get started. So the first, we always ask you to consider all of your charitable objectives along with your other planning objectives. Good advice to talk to your tax advisor and your estate planner. And of course, it's a perfect time to discuss your ideas and your passions and your interests with your family. Certainly, this Thanksgiving will be different than every other Thanksgiving. Might be conversations you have to have over the Zoom table. But we also suggest that you discuss your ideas with Robert, with RJF, to see what planning opportunities there might be. And some of the things you might want to think about, we've talked about outright gifts, creating or funding a DAF or an endowment fund, or taking advantage of the education improvements, scholarships, tax credits. There are many opportunities for charitable giving at your end. And of course, the last is to implement your year-end giving strategy and to do it pretty quickly because the year-end is coming fast. So with that, I'll stop, and I think we might have a question or two, Adam.
So what are your thoughts, recommendations on charitable gift annuities?
Great question. And I thought we wouldn't have time today to get into some of the life income strategies, such as charitable gift annuities, charitable remainder trust, and charitable lead trust. But in terms of charitable gift annuities, in this low interest rate environment, they are an attractive charitable option for clients. Because under the charitable gift annuity, you're guaranteed a payment for life that is a much higher payment than one might get, for example, investing in a CD. So you get an income tax deduction up front for the charitable interest, and then payments over the course of your lifetime, or your lifetime can be or another person's lifetime. And people use charitable gift annuities during lifetime and also set them up sometimes as part of their basic plans.
There was an additional question for Lisa, which she actually answered by typing it in, but I just want to make sure everyone heard it. The question was, what if for the family investment loan, the stock market declines by 20%? There have been stock market contractions over history. You want to address that, Lisa?
I do have to unmute to do that. Yeah, the family investment loan probably works best. I think I illustrated it as 3 years, but I think it works best if it's a 20-year loan. I mean, if I have 20 years to go, the stock market's gonna do as it does and probably recover, lose and recover a number of times over that 20 years. If it's a short term, we would actually probably recommend that you do a grantor retained annuity trust. As I said before, it kind of works like a loan. You put $1 million into the trust, and then you get back an annual payment equal to, let's say it's a two-year trust. You get half of your $1 million back each year, plus a little bit that interest rate that the government imposes, the 1.2%, and then all the growth goes to your heirs. But if you're in a stock market decline, there's no harm, no foul on that, because all that happens is that everything in the trust comes back to you, and it's drafted so that there's no gift tax consequences. And if the market is in decline, the only thing that you're out is the cost of actually creating the trust itself, which is probably $5,000 or $10,000.
Any other questions from the group? Well, this has been great. We very much appreciate you having us on. I know that there were I believe, continuing education credits affiliated with this webinar. At the same time, please feel free to reach out to any of us at any point in time. We very much value our partnership we have with RJF, and please use us as a resource as needed. But we just want to say thank you very much for having us on today, and we hope you all stay safe and at the same time have a happy Thanksgiving. With that, Robert, did you want me to turn it back over to you?
Thank you all. I appreciate your wonderful wisdom as always, Team Glenmead, and everybody joining us today. Thank you for spending some time with us, and always available if there are any follow-up questions or if there are any specifics that the folks from Glenmead can answer. I'll certainly pass it along to them. But with that, thank you for joining us, and everybody have a safe rest of the day. Thank you.
Great. Thanks, everyone. Bye-bye.